Yo, what's going on, traders? It is your boy, the Master of Coin, and today we are back with a highly requested Forex smart money case study. Now guys, the case study we're going to be going through today is actually on silver. Now I will go back and provide you guys with the timestamps and the dates, so you guys can definitely go back and backtest this. But this trade specifically managed to produce over 500 pips with less than a 3 pip stop loss, which actually managed to again result in over a 1 to 150 risk to reward. Now I know here in a trade like this, first, if you're new to smart money, you're new to these type of concepts, you might be thinking 1 to 150. That's insane. That's impossible. That can't happen in the market. Well, guess what? It can, and I'm about to show you exactly how it did happen and how it continues to play out. So, first things first, right? With all of our analysis, we're always going to start on a top down. So, with our top down analysis, what do we firstly can investigate on the monthly? Well, what do I see? I see these lows here. Now, I see that these lows on the monthly time frame have been clapped, right? We got our manipulation of a low and our breaker structure to the upside. So this is now showing me that my monthly time frame is now bullish. And now because our monthly time frame is bullish, well, we might have some potential strength. Now again, a lot of this price action is back from 2015, so it may not be too relevant to us now. But the only reason I'm looking at here is to see a potential agenda. If price does start to collapse down, well, we can definitely expect it in the future, to come back to these levels to mitigate. But again, that's not relevant for now. What's relevant is that the monthly is bullish and we've got a lot of higher time frame strength. So we can now scale down to the weekly. Weekly, what do we see? Same thing, bullish price action on the weekly time frame. So we are now starting to build our evidence and our agenda of what we want to do. Our higher time frames are bullish, so we want to be trading in alignment with these higher time frames. So let's now scale down to a daily. On our daily, well, what can we see? We can also see, let's walk through the structure, right? We've got our price had a low, high, higher low, higher high, higher low, higher high, higher low, and it tried to create a new higher high, but price failed and it looks like it created a new lower low. But what you guys got to see here is that this is actually a complex pullback. On the daily time frame, your structure points are between here and here. So whatever happens between here is all going to be a complex pullback, and it is designed to confuse traders. So what do we see happen? Price pulled up, higher high, potential higher low, potentially higher high, and it created a new lower low. Now, what did it print after that? Another aggressive move to the upside. So this is now giving us evidence that our daily time frame is now bullish, right? Our daily time frame is now bullish. Now again, this is still not enough to enter a trade, but what I want you guys to notice is our daily range. Now, I know you can't see the daily range right now because I'm obviously putting text on the charts, but let's see if we can see the daily range we're playing in. The daily range we're looking to play in is between this low and this high, because this was the low that led to a new high. So this is our daily range. So within this daily range now, we want to be investigating potential demand zones, potential areas that price may want to react from. Now there's multiple different reactions. There's multiple different POIs here. Especially if you know smart money, you've got one here, right? You've got one here, and then you've obviously got one here, and then you've got one here as well, right? How are we going to know what one to take our trades based off? Well, that's the thing. We don't, right? We don't. We don't. We have to wait for the market to show us what it wants to do rather than us tell the market what we want it to do. So on our daily time frame, right, we can see how price traded within this daily IC candle. So if price, trades into this daily IC candle, what can we expect? Well, on a lower time frame now, our 4 hour, we're going to expect some potential bearish structure, because as price is trading in, right, to our daily POI, we can expect some pullbacks, right? And the lower time frame is going to have bearish structure because we're pulling back. So if we observe the 4 hour structure, right, higher high, higher low, tried to push a lower high, price came down, formed a new lower low, but what happened? It quickly reversed within that demand zone and then pushed straight back up and broke structure. So now this is showing me that my 4 hour structure is now bullish. So what are we doing here? again, we're just building up a case, right? Our 4-hour structure is bullish. Weekly, daily, monthly is bullish. We've got a lot of background strength. Of course, you can, capitalize on sell positions, but the type of trader I am, right, I'm not really going to go against that at the moment for this specific type of trade. Now, notice what happened as price traded into our daily demand zone. It came in perfectly to our 8-hour refined IC candle within the daily, right? So we're refining it. Now, notice what happened as price traded into this demand zone. It came in first, it set a low, and then it instantly reversed. Now, this is very interesting, and this is very important you understand what's happening here. This low that was set, what did this do? This enticed traders, right? This enticed retail traders. Anyone who was buying had their stop losses relatively below here, right? Now, notice how price set the low, reversed, set the low, reversed, and then come to clear the low. But notice how that clearing of the low came back to mitigate this institutional candle here. So this is now showing us evidence that this market is definitely being operated with some higher agendas at play, right? Because we're seeing manipulations of the low followed by a what? A breaker structure to the upside. Now, when you see manipulations of a low and then breaks of structures to the upside, you can now anticipate that accumulation may be in play. So, if we go back to our 4-hour, right? 4 hours bullish. Now, let's investigate, guys. Let's investigate this wick here, because this wick looks very peculiar. What does this look like? A sell before we buy movement. Now, we understand that in a sell to buy movement, well, any orders that were sold here, right, again from institutions, need to come back to be mitigated. So what do we see? Right, let's investigate. Let's look at this on the hourly time frame. Well, on the hourly time frame, it's looking a lot clearer that this is an institutional candle. So what can we do? We can mark up our institutional candle. Now, notice what happened. If we look right, price now trades within our IC candle. Now, this is not the only thing that's important. Look what else happened. We took liquidity. And we have liquidity left. We have resting liquidity. So typically if price takes liquidity from one side, we can now expect or potentially anticipate, again, with other confirmations, right? Again, nothing is 100%, and you can't just trade one concept by itself. You need higher and multiple confirmations, right? You can't just take a trade based on one thing. So we had a manipulation of the lows, and there's still highs that are intact up here. We can also expect some low resistance highs here. We've got liquidity resting above here, and there's some more just here as well, right? A lot of low resistance highs. Now, we've got our hourly mitigation, and we see an hourly breaker structure. So we can also say that our hourly time frame is now bullish. So because our hourly time frame, look what's happening. All of our time frames are in alignment. So now we can step down. Now on the M15, what do we also see? Right? We can see this sell to buy movement. Now notice how price comes in to our refined institutional candle. Now again, I'm not going to go into detail on why this is the institutional candle specifically, but that's for another video. Now, this is our mitigation of our M15 IC candle. Now, on the M15, this is still, for me, too high of a time frame to enter based off because, well, realistically, entry is going to be there, stop loss is going to be there, 20 pips. I'm not really trying to take a trade with a 20 pip stop loss. So, what am I going to do? I'm going to wait for my lower time frame confirmations. So, if we now scale into the M15 time frame, what do we see? Well, if we look at structure, lower low, lower high, lower low, lower high, lower low. Price came up, broke structure. We are now in bullish conditions on our M5 time frame. Now again, I've got to put the M15 as well. Bullish, and then M5 was also bullish now. So where are we going to take this trade from? Well, we've got our range now on our M5 time frame, right? From our low to our high. So if price is going to remain bullish, realistically, it should respect any sort of bullish institutional candles within here. So where are our bullish institutional candles? Well, we've got one here on the M5, and that is it. Now, why am I not actually going to mention this institutional candle? Now, of course, it could potentially be valid, but it's already been mitigated by this candle here. It sold, wicked down, came back into these sell orders before rising higher. So, I mean, don't get me wrong, it could have potentially came down here. And if it did, well, you know, I guess we just would have to taken a small loss here and then re-enter the trade. But I was confident enough to take the trade here simply because of this simply because of this reaction we saw. We saw that sell before the very quick expansion that led to a break of structure. So on a lower time frame, potentially on your 5 second, this is going to be a reaccumulation of price. So if we now scale down to our M1 time frame, we can further refine our institutional candle and we can refine it down to here. Now, with this refined institutional candle, you can simply enter here above the open and your stop loss can literally go just at your low. Now again, there was, like I said, a small bit of potential for price to come and trade into here. If it did, well, we just would have had to, potentially take another loss. Now, well, where would the loss would come from? Well, if you went it here, right, your loss would have got, well, you would have lost that trade, and then it would have came down here and potentially went higher or potentially went lower. We don't know yet. So what do we see? We see as price trades into our demand zone, we see evidence of professional accumulation where price starts to move lower, and we can see accumulation enter the market here. We can see the volume start to enter and start to pick up. So this is a divergence in price, which is showing us that price may want to go higher. Now, again, confluence. Notice how that happens as we trade into our demand zone when all of our time frames are bullish. We also see this happen below the opening price, right? This candlestick here, 8 a.m. GMT, this was the London opening price. Now, what typically happens at London Open, you see some fake outs. We see here, right? Fake out and a rally. Now, what has happened here? Well, some people at London Open, they were shorting, they were selling. So anyone who was selling here, well, they got wiped out by that buy. And then what happened? The latecomers to the party, they brought. And notice how price comes back down to take them all out. Again, this is why you need to be patient and let price come to you, rather than you trying to chase all the little crumbs in the market. Be abundant and let price come to you. Now, notice how it comes and dips below this opening price. And the reason we look for this opening price is because if we're in bullish conditions, we want to be buying anywhere below the open. And if we're selling, we want to be selling anywhere above the open. Now, again, this is adding a lot of confluence. Again, this was in alignment with a massive yearly seasonal move that happens and with our weekly cycle as well. Now, again, I'm not going to go through the weekly cycle. I'm not going to go through seasonalities today. But now we can start talking about targets. So where are our targets? Well, we have firstly liquidity resting above this high that can be a target. But again, remember what we're playing off. We're playing off a daily institutional candle, right? We're not playing off an M1 IC candle. So because we're not playing off an M1 candle, we can actually have daily targets because we're playing a daily move, right? That's what we're doing. So where can our targets be? Well, firstly, we can target liquidity resting above this high. And secondly, I see these low resistance highs over here. Now, these low resistance highs, these have been here for a while, right? Since, August 2020. So because these highs have been here for a while, we've got liquidity resting above that. Now, this liquidity resting above that, let's see, right? Let's see the price point, 29.843. Now, typically, where a stop loss is going to be 20, 30, 40, maybe 50 pips above the high. Now, notice the round number that is slightly above this price here. We're at 29.843. We are very close to the whole psychological number of 30, right? So if we look at 30 as a potential target, how many pips above the high is this? We're talking, 12, 15 pips above the high, 16, 17 pips. So that is where if stop losses are above there, because again, technically, ultimately, we're never going to actually know if there is orders above there. It's just based on my trading plan and my back testing. But the stop losses who should be above here will be around 15, 20 pips. And again, 30.0, very psychological number, very nice and round. If any institution is getting involved, they're going to want to be taking orders around whole numbers. such as 30, very attractive. Now, what do we also have? Again, on our hourly time frame, we also had our equal highs as well. So if we actually go back to our, our PN, here we go. Now, if we extend this, if you want to target these low resistance highs up here, that will give you a 1 to 14. But again, we can understand that this is a trade that is going to play out, or if it is going to be right, if it is going to be valid, it should play out to our daily targets because we're looking at a daily move. Now, if you want to have your target 1 at these equal highs here, that's going to be a 1 to 35. If you want to have your target 2, potentially at this imbalance up here, or if you want to have it above the liquidity over here, that's entirely up to you. That would be around a 1 to 90 R&R if I'm not mistaken. Let's look. Yes, 1 to 96. Now, if we zoom out, remember, we said daily targets, right? Why daily targets? Because we're playing a daily move, so we can have the higher time frame targets. So, zoom out. Our target of 30. We obviously explained why it was 30. So cool. There's our target of 30. Another thing, weekly cycle, professional accumulation as price came into these zones again. Again, more evidence of professional accumulation. We can see the demand is literally still entering the market. The demand line is still rallying as price action is falsely moving down. Again, this is done to shake people out because most traders have to lose. Guys, you need to understand that. Most people need to be losing. Most people need to get wiped out of the market before the market can continue to unfold. So what happens after this? Well, it was literally just a case of sitting back and allowing price to do its thing and having that patience, right? We can see price comes in and then starts to rally. At this point, as price has broken structure, you can then break even your trade. You can then, again, when you're trading at around a 1 to 10, if you're risking 1%, you can take that percent off the table and essentially take, again, when I say taking profit, we're not taking and closing the trade. What we're going to be doing when we're up around the 1 to 10 is we're going to close our initial risk. So for example, if we're up, let's just say we risk $100, right? And let's say we're up a 1 to 10 and we're up $1,000, right? Because if you're up a 1 to 10 risk reward, well, you're going to be up $1,000 if you risk 100. So if for whatever example, if for whatever reason we use the 1.0 lot size. Now again, I know this maths here is not correct. This is solely for example purposes. With this 1.0, what you would simply do is if you're a 1 to 10, you would literally just close 0.10 of your lot size, which would be $100, and then boom, your risk is off the table. So you could do that instead of breaking your trade even, or you could just break your trade even. It's entirely up to you what you prefer to do. And then from that, it was just about being patient and allowing you just to have confidence in yourself, confidence in your seasonal moves, confidence in your structure, confidence in all of your confirmations. As we can see, price absolutely rocketed to that target before reversing. Now, this trade here again was documented in my public Telegram channel. So if you're not in the public Telegram channel, make sure you are. The link will be in the description. But this was an absolute screamer. And again, this move happens pretty much every single year if you look for the right setups, the right confluences. This is a very seasonal move. But with that being said, that is pretty much all I wanted to go into today on this case study. It was a very quick one, very brief one. If you guys did like this, then we can definitely go into some more, and we can definitely look into more more case studies in the future. So with that being said, guys, definitely join my public Telegram, t.me/IKDavis. If you guys have any questions, I'm more than happy to answer them. Either contact me on my personal Instagram or just leave a comment down below and I will get back to you. With that being said, guys, thank you all for your time, and I'm going to see you all at the top because the bottom is way too crowded. Let's get it, man. Sheesh.